Taking you on, investment strategy. So how have we done against our three-pronged investment strategy, which hopefully you're familiar with by now? We try to only invest in good companies. We try not to overpay when we're buying or holding the shares. And then we do the most difficult part, which is nothing. How are we doing against those three legs? I'll run you through the usual tables that we give you and a couple of extras this time. There's our look-through ratios. This is where we take our portfolio, work out 5 operating financial ratios for it, and compare what our companies are doing versus the indices out there. And so that's what we've got here. And if you look at it, the return on capital at our companies last year, ROCE in the table, return on capital employed, was 28%, a recovery from the prior year when there was a bit of a downturn caused by the pandemic. This is highly satisfactory insofar as it's back to where it has been in the long term, and you'll see that it's significantly ahead of where the index are, whether it's the S&P or the FTSE. Over there on the right of the table, you see about 14 to 16% return. So to put it in English, for every pound or dollar of capital we own in these companies in our portfolio, we're getting 28 pence or cents of profit return, whereas if you're in the index, you're getting about 15 pence. Our companies are delivering round about twice as much return, and I think that's the single most important metric to look at when you look at our companies performing. Gross margins, these are the difference between revenues and cost of goods sold. Companies take in stuff, they take in ingredients or components or services and do something with them and turn them into products and services that they sell. This is the markup, the difference between the two. Our companies are at 64%, which you'll see is pretty rock solid down the years. Basically in English, they're making stuff for 36 and selling it for 100. If you look over at the index, you'll see around 45%. Companies in the index are making things for 55 and they're selling it for 100. Clearly, it's better to make things for 34 and 36 rather than sell it for 100 than it is to make it at 55 and sell it for 100. I mean, one's obviously better than the other. It's also something I think we'll come on to in the questions again, because I'm pretty sure Ian's got a couple for us on the inflationary outlook at the moment. And this, I would suggest to you, is the biggest single defence, first line of defence against inflation of a company, its gross margin. Take out all the other expenses our companies incur, selling, general and administrative expenses, they call them SG&A, and you get down to the operating profit margin. You'll see last year, again, a bounce back from the pandemic, 26% against 23% the year before, and it compares with 15 to 17% in the index. Again, very much better than the index. Cash conversion, our companies converted 95% of their profits into cash last year. The index had a particularly good performance. You'll see out there producing somewhere in the region of 108 to 124% of profits in cash. This is a bit of an unusual feature, and the index is performing particularly well at the moment for a couple of rather strange reasons. Bear in mind this is a ratio, and if you make your profits go down more than your cash flow, your cash conversion looks good. It's not a very good place to be, but nonetheless that's how the ratio comes out. And the reason that's happening is companies in the index, by and large, had bigger falls in profitability than our companies did. And at the same time, because of supply chain difficulties, they had an awful lot of stock out, so their working capital went down, invested in the business. So they didn't make as much profit, but they converted more of the profit into cash. I've got a slide to illustrate that in a moment. I think that will reverse as we start to emerge from the pandemic. And lastly, interest cover. So is all this wonderful operating performance that we're getting from our companies being delivered with a lot of borrowed money and balance sheet trickery? No. Our companies last year had 23 times interest cover. So their profits, compared with what they're paying out in interest and lease rentals, was 23 times. I mean, these are very strong balance sheet businesses, basically. You can see they delevered last year at 16 times the year before. The index, not in bad position. If you look, 8 to 9 times interest cover is pretty good, but clearly these are very conservatively financed companies. They're not producing this performance out of financial engineering. I said I'd just show you a little illustration on the cash conversion. Here's two companies to look at, BP and L'Oreal, one of which we own, L'Oreal, one of which we would never own, BP. And if you have a look, you can see some pretty interesting numbers in terms of cash conversion. When we made this up, it was before we had the full year figures, and you can see, although L'Oreal was doing extremely well, 133% for the last 12 months, BP shot the lights out at 147%, which looks great just as a spot calculation. But if you take the longer sweep, you'll see that the BP one is highly volatile, minus 141% if you go back to 2016, compared with 147% now. And an average, as you can see there, of just 66% cash conversion over the last 7 or 8 years. Whereas our L'Oreal, you can see, has got an average of 110% over the last 7 or 8 years. Clearly, L'Oreal is a consistently high cash conversion converter, whereas BP is very volatile. And we're just getting a piece of volatility which is making the figures look that way at the moment. You can also see that cash conversion, if you look back over the 8 years, BP's net income has gone down very significantly. It's quite close to having halved, whereas the cash flow has gone down less. It's not a great way to create value for shareholders, having your cash flow go down less. And it's better than the opposite, obviously, of having your cash flow going down even faster than the profits, but it's not a great leap forward, is it? To have a greater cash conversion merely because the cash flow falls slower than the profits over a period. Don't overpay, second leg of our strategy. This is probably the most vexed part of our strategy over the years. People are always worried about whether we're overpaying. We worry about whether we're overpaying. Where are we? You'll see last year we finished the year with a free cash flow yield of 2.7%. So take the free cash flow that our companies have generated after paying for everything except the dividend, which is a distribution from the cash flow that we own, and you'll see that it was 2.7% when that is divided by their market value. How does that compare with the index? Well, you can see there 5.4% for the FTSE. The companies we own are about twice as highly rated, have half the yield of the FTSE. I personally wouldn't worry about that a lot because I think an awful lot of the stuff in the FTSE is very poor quality stuff that's not going to produce great long-term returns for you. We're still a bit more expensive than the S&P. You can see there 3.6%. Now, yeah, we are more expensive, probably about 25% more than the S&P. But that doesn't unduly worry me, I think, because what you've got to ask yourself is, yes, we are more highly rated, but it's not expensive if the quality of our companies is even more significantly higher than the index, than the rating on the shares would suggest. And so I'd ask you to think back to that look-through table and think, are these companies 25% better than the index, 50%? Yeah. When you look at the range of those figures, whereabouts to get you, and there's a clue at the bottom of this table. You can see the free cash flows on our companies grew 20% last year, or as we call it in the analytical team as a technical term, quite a lot. You know, that's basically telling you that, yeah, we have got slightly more highly rated companies, but they're growing faster than the market, and they've got better operating ratios. Because I think what we're trying to get away from in representing this to you is the idea that lowly rated equals cheap and highly rated equals expensive. It depends what you're getting. It's like anything else in life that you buy. Fords don't cost the same as Ferraris, right? And therefore the fact that one is priced lower than the other doesn't in itself tell you anything about the bargain that you're getting. Okay. Do nothing, final leg of the strategy. Here's a table which shows you the T-class shares and what we did last year. You'll see that our portfolio turnover was 5.6%, well within our band for the last few years, nowhere near the highest turnover we've got, and I'm absolutely certain very significantly lower than the average active fund manager out there. You'll see when we come on to talk about the names on the next slide that, as ever, there are more names that we traded than the percentage would suggest, which offers, some people often wonder, well, I wonder how that could be. The answer is very often the things that we sell, because we haven't been adding to them and because they maybe haven't performed all that well sometimes, they drift down as a percentage of our portfolio. So when we sell them, there's not such a big impact on things. Another sort of indicator of dealing not with the portfolio turnover percentage, which tells you something, is how much we actually spent on this. You can see we spent 0.009% on dealing. So basically less than 1/100% on dealing was spent last year. A bit over £2 million on a fund of 27-28 billion pounds. As ever, the broking industry will not become rich if everybody runs money like this. Everybody won't run money like this, so the broking industry, I'm sure, has a great future ahead of it. But you can see that we basically don't do very much dealing.